Imagine a corporate giant, a real household name, suddenly facing this do or die moment.
Hmm.
In an industry moving at light speed, can this legacy titan truly reinvent itself for the AI revolution? Or are its best days, it's a technological supremacy, firmly in the rearview mirror? That's really the billion-dollar question for Intel, isn't it? A company making this audacious, high-stakes bet. It could lead to a spectacular comeback or, well, a prolonged, painful decline. The answer won't just decide the fate of a $100 billion company. It's going to profoundly reshape the global tech landscape. Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're taking a whole stack of sources, reports, analyses, crucial financial data, all anchored to today, August 23, 2025, with Intel's share price sitting at, $24.80. Our mission, a deep dive into Intel Corporation, ticker symbol INTC.
Exactly. And our job here is to cut through all the noise around Intel. We want to reveal the insights that really matter, help you understand the full picture. It's intricate. We're talking about their ambitious turnaround of the business, leadership, financials, and, how the market sees it, who owns it, and definitely the big risks involved in this massive transformation.
Okay, so to really get a handle on Intel's huge bet on its future, we've got to start peeling back the layers of its core strategy. Let's kick off with Chapter 1, the Silicon Giant's Gambit, a new era for Intel. Intel in 2025 is, well, it's a company in radical transformation. You said it. Every part of its business model seems to be getting fundamentally reshaped. So what exactly is this IDM 2.0 strategy that Intel is betting its entire future on?
Yeah, it's fascinating, right? IDM 2.0 is basically a complete reimagining of Intel's whole role in the semiconductor world. For decades, Intel was, purely vertical. Designed its own chips, made its own chips. Simple. But after losing that manufacturing edge, well, a new strategy wasn't just essential, it was existential. Think of IDM 2.0 like Intel deciding to cook its own food again, but in a brand new, super high-tech kitchen. And at the same time, offering to cook for other people too. It's built on three core pillars, really. First big one, investing just a massive amount, over $100 billion, to revitalize their own factories. We're talking new fabs, expanded fabs in the US and Europe. The goal, regain tech leadership, ensure a resilient supply chain.
Okay, so bringing manufacturing back home, essentially.
Exactly, and securing it. Then pillar two, a big shift, strategically embracing external foundries, like TSMC, the leader. This lets them use a chiplets design approach. It optimizes cost, performance, pick the best process for each part of the chip.
More flexibility then.
Right. And the third pillar, maybe the boldest move of all, launching Intel Foundry, or IF. This is their huge push into contract manufacturing, competing head-on with TSMC, Samsung, especially aiming for customers for advanced processes like Intel 18A. That's their next-gen tech. It's a massive, massive wager. Billions going in. And for investors, it really sets up a near-binary outcome. Win big or well.
Wow, that is quite a transformation to wrap your head around. So how does this new strategy actually, translate into their current products, their revenue streams today?
Okay, so Intel's business breaks down into a few key segments. Their traditional stronghold is the Client Computing Group, CCG. That brought in $7.9 billion in Q2 2025. That's where you find the familiar Intel Core chips and the newer Intel Core Ultra. And those Ultra chips have that dedicated NPU, the neural processing unit, for on-device AI. That's key.
Ah, the AI angle, even in laptops.
Yep. Then there's the data center and AI segment, DCAI. That's really their main growth engine now, $3.9 billion in Q2 25. Here you've got the powerful Xeon processors for data centers, and crucially, the Intel Gaudi AI accelerators. They're positioning Gaudi to compete directly with NVIDIA in AI training.
Taking on NVIDIA, that's ambitious.
Definitely. They also have Network and Edge, NEX. That's processors for 5G infrastructure, edge computing, important stuff. And finally, the newest, most critical piece, Intel Foundry, IF. It did $4.4 billion in Q2 2025, but that's mainly packaging, legacy services right now. Its future success totally tied to getting big external customers onto those advanced processes like 18A.
Okay, strategy, products, but let's zoom out. What's the most compelling insight here about Intel's current market position? With all these huge shifts, Intel's a titan, but its kingdom is, well, clearly under siege.
Yeah, if you connect the dots. Intel was still the world's third largest semiconductor maker by revenue in 2024. Huge company, over 100,000 employees, massive capacity, 250,000 wafers a month. But the critical insight, the erosion of its dominance, that's the key takeaway. Its capacity 86 market share, once near total monopoly, was down to 68.4% in 2023.
Ouch. Mostly lost to AMD.
Primarily, yeah, because of Intel's past manufacturing stumbles. So now they're fighting on multiple fronts, data center and AI against AMD and NVIDIA. And in the foundry business, they're basically starting out as a distant third behind TSMC and Samsung.
Right. So with all these changes, how has Intel's core value proposition actually shifted? Why should a customer, or maybe even a government, care about Intel today, beyond just its past reputation, I mean?
That's a great question. What does Intel Inside even mean anymore?
Hmm.
Historically, yeah, it meant performance, raw speed. Today, especially for governments, big enterprise customers, the
Yeah.
proposition is way more complex and maybe more compelling. It's shifted towards security and resilience. That's the new angle.
Because of geopolitics.
It's exactly geopolitical tensions, supply chain worries, especially around Taiwan. Intel's U.S. and Europe-based manufacturing from IDM 2.0 suddenly looks like a very secure, advanced alternative. For a lot of buyers now, a secure supply of critical chips is just as vital as raw performance. Maybe more so.
That makes a ton of sense, especially in today's world. Okay, let's broaden our view now to industry analysis. What are the big market trends shaping semiconductors right now?
Well, the whole industry is in a kind of super cycle. It's projected to grow, 11.2% in 2025 to over $700 billion. And that growth is massively driven by demand in AI, expected to be over $150 billion just for AI chips in 2025. Plus, data centers, automotive, those are booming too. And Intel's whole pivot with IDM 2.0, it's aimed squarely at those high growth areas.
So Intel's trying to surf that wave, but who are they actually up against in this booming market? Who are the big competitors?
Oh, it's a multi-front war, no doubt. In foundry, they're up against TSMC, which has like 60% plus market share, and Samsung, huge players.
A tough fight.
It's very tough. In CPUs, it's AMD, Advanced Micro Devices. They really capitalized when Intel stumbled on manufacturing. And in AI accelerators, the 800-pound gorilla is NVIDIA with their GPUs, just dominant. Intel's challenging with Gaudi, but yeah, it's a steep uphill climb. Then you got the regulatory side. The US TEPS Act, over $52 billion in subsidies. That's a massive tailwind for Intel. They're the biggest beneficiary.
Right, government support.
Huge support. But international rules like REACH, RoHS, trade tensions, especially US-China export controls, those create real challenges for global operations. And don't forget the barriers to entry here are insane. We're talking over $20 billion for one advanced factory, billions in R&D, deep IP moats. It's not an easy business to be in.
Okay, so given all that, what does it mean for Intel's competitive advantage? Their moat, as they say. Has it been breached? Or are new ones forming?
That's the million-dollar question, isn't it? Their traditional moats, yeah, they definitely saw some cracks appear, serious ones. But interestingly, they are building new ones or maybe reinforcing old ones in new ways. That Intel Inside brand, it still carries weight, especially with big corporate customers. There's inertia there.
Familiarity counts.
It does.
Yeah.
And historically, their massive scale gave them huge cost advantages. Those eroded when fabs weren't full. But if IDM 2.0 works, if they fill those new fabs, those scale advantages could come back. Then there are the network effects, the switching costs tied to the BK6 architecture. Most of the world's software runs on BY86.
Yeah.
Moving off it. It's incredibly complex, expensive for big customers. They're kind of locked in. But what's really fascinating, maybe unique now, are a couple of things. One, Intel is the only US-based company that can design and manufacture leading-edge logic chips at scale.
The only one.
The only one doing both at the highest end, based here. That national champion status. That directly led to the CHIPS Act support, and even that direct U.S. government equity investment we'll talk about. And two, they snagged a first-mover advantage with ASML's new high-NA EUV machines.
Those are the super advanced chip-making tools.
Exactly. Think super high-precision lasers carving tiny circuits. These are critical for making sub-2 nanometer chips. It gives them the potential window, maybe, to leapfrog back into process technology leadership. It's a big deal.
Okay, so much change happening. Let's pivot now to the people actually steering this massive ship. We're diving into Chapter 2, a new captain at the helm, evaluating Intel's leadership. March 2025, Intel appoints Lip-Bu Tan as CEO, taking over from Pat Gelsinger. What's Tan's track record like, and what does this leadership change really signify for Intel's future?
Well, Pat Gelsinger, he was definitely the visionary, right? He architected the whole IDM 2.0 strategy. But his tenure, let's be honest, was marked by persistent operational challenges, execution issues, and the stock price really languished.
So strategy guy out, execution guy in.
That's pretty much the narrative. Lip-Bu Tan signals a clear shift from strategy talk to actually doing it. Execution. He's highly respected, former CEO of Cadence Design Systems. He doubled revenue there, delivered like 3,200% stock appreciation, incredible run. His reputation is as a disciplined operator, so the board's choice suggests they think the strategy itself is sound. But now they need someone who can prove they can execute, deliver actual financial results.
Makes sense. Shift from vision to the gritty details of making it work. How transparent and ethical is Intel's leadership in their communications, especially with this new captain, given, Intel's past struggles with meeting the expectations they set.
Well, officially, Intel has its code of conduct, emphasizes integrity, transparency, standard stuff. Pan's message so far is focused on Intel being an engineering-focused company, building trust through execution. Actions speak louder than words.
Needs to, right?
Absolutely. Because, critically, you have to look at the history. There's been a gap between Intel's often optimistic narrative and the actual results. Repeated delays, financial shortfalls that erodes trust. So the challenge for this new leadership is huge. Bridge that gap. Rebuild confidence by consistently hitting milestones. Not just talking about hitting them. That's how you earn back trust. Plain and simple.
So, speaking of where the rubber meets the road, what does Intel's capital allocation policy tell us? Where are their strategic priorities now? Where's the money going?
Yeah, the capital allocation tells a very clear story. Priority number one is reinvesting in the core business, period. They're forecasting a massive $18 billion in gross capital expenditures for 2025.
$18 billion. Wow.
Pouring money into new fabs, advanced tech, plus heavy R&D spending. Their M&A strategy seems more about fine-tuning strategic acquisitions, divestments like spinning off Intel Capital, but the really dramatic shift, shareholder returns, share buybacks. Suspended since Q1 2021, the quarterly dividend, slashed by 66% in Q1 2023, from over 36 cents down to 12.5 cents.
That's huge. Changes the whole investment story.
Fundamentally, it's no longer an income stock. It's a speculative growth play on the turnaround. And the ultimate report card for all this investment is return on invested capital, ROIC, right now. It's dismal. Negative 7.28% TTM as of Q2 2025.
Negative. So the investments aren't paying off yet.
Worse than that. The critical insight here is that these billions in investments are currently destroying value. Reversing that trend, that's Lip Dutan's absolute central challenge.
Okay, time to pull back the curtain for Chapter 3. Under the hood. A forensic attention. Look at Intel's financials. The numbers. They don't lie, right? They reveal the unvarnished truth no matter how grand the vision. What's the story here for Intel's financial health?
Well, the financial story is one of pretty significant deterioration, honestly. Intel's market cap is around $108.5 billion. That sounds big, but it's a shadow of its former self. And it's just dwarfed by competitors like NVIDIA at, what, $4.34 trillion?
Trillion, yeah. Different league right now.
Totally different league. And revenue. Steady contraction over 5 years, fell from nearly $80 billion peak in 2021 down to just over $53 billion TTM ending June 2025. That's a 3.7% decline overall.
That's a serious downward trend for a company this size. What about profitability, making money from those sales?
Yeah, that's where it gets truly alarming. Profit margins collapsed dramatically. GAAP gross margin was just 27.5% in Q2 2025.
27.5. Wasn't it over 60% not long ago?
Exactly. Down from 60% plus just a few years back. It's a shocking drop. And GAAP operating margin, negative 24.7%. Yeah. Staggering loss. Their TPM net profit margin is negative 38.64%.
38% loss on the bottom line.
Yep. The critical insight here, Intel's core business is currently operating at a significant loss. It's stark, it's unsustainable compared to their historical financial strength. It just shows a company right now unable to cover its massive fixed and operating costs.
Wow, negative $15.7 billion free cash flow burn in 2024. That's an eye-watering amount of cash. It really underscores the sheer scale of this turnaround effort, doesn't it?
It absolutely does. Free cash flow generation has seen just this breathtaking reversal, from generating over $21 billion in 2020 to burning through a staggering negative $15.7 billion for the full year 2024. This massive cash burn, that's the direct real-world cost of the IDM 2.0 strategy. And you just can't keep doing that indefinitely. Something has to give.
So given these numbers, what about Intel's actual financial stability? Can they keep this spending up without hitting a wall?
Well, historically, Intel had a fortress balance sheet, but it's definitely showing signs of strain now. Earnings consistency, that was a hallmark for decades now, broken. TTM EPS as of June 2025 is a loss of $4.75 per share.
Oof.
Yeah. Their debt-to-equity ratio is still manageable, 0.42, but it is trending up, so that needs watching closely. The current ratio, measuring short-term liquidity, is 1.24. That's above 1.0, which is good, but it's declining from healthier levels.
Tighter than it used to be.
Definitely tighter. And like we discussed, dividend stability, gone. The 66% cut means its long-term sustainability depends entirely on getting back to positive free cash flow.
Valuing a company like Intel, mid-turnaround, it's notoriously tricky, right? What does a valuation analysis tell us about Intel today? Where does it sit?
Right. Standard PE ratio,
Hmm.
Meaningless right now because earnings are negative. But if you look at price to sales, Intel trades around 2.0 times its trailing 12-month sales.
2 times sales. How does that compare?
Well, it's a stark discount compared to peers. AMD is at 9.8x sales, NVIDIA is at 35.0x, TSMC is 9.5x.
Wow. Okay. So the market is deeply skeptical.
Clearly, it reflects the huge execution risk and the current lack of profitability. No doubt about it. Now, if we try an educational discounted cash flow, or DCF, model, remember, that values a business based on its future cash flows, discounted back to today, using a relatively high discount rate, weighted average cost of capital, or WACC, of 8.5% reflecting the risk, and a conservative perpetual growth rate of 2.5%. We get an estimated intrinsic value range of, let's say, $22 to $30 per share.
$22 to $30.
Yeah, which suggests the current trading price, $24.80, is actually within that range.
Fairly valued.
Fairly valued if, and it's a huge if, the turnaround ultimately succeeds. That's the kicker.
Okay, moving into part 2 now. Let's look at chapter 4. The market's verdict. Gauging sentiment on Intel. So what are analysts saying overall? How is the market perceiving all this change, all this uncertainty?
Well, the analyst community is, frankly, deeply divided. The consensus rating is basically a hold, wishy-washy. But look at the one-year price targets. They range wildly. Low of $14, high of $62.
15 to 62. That's an enormous spread.
Exactly. It just highlights how binary people think this investment thesis is. It could go either way spectacularly. The media narrative is also kind of split down the middle.
Yeah.
You get positive strategic news, SoftBank putting in $2 billion, that impending $8.9 billion U.S. government equity investment, stuff that paints Intel as this national champion, maybe too important to fail.
A hope story.
Right, the hope story. But that's constantly bumping up against overwhelmingly negative financial news, continued losses, misguidance, that massive cash burn we talked about. So you've got this clear hope versus reality dynamic playing out in real time.
Are there any other market indicators, things that give us clues about sentiment, momentum, beyond just the headlines?
Well, short interest is moderately elevated, around 2.75% of the float. That's about 120 million shares. It indicates, a degree of skepticism among some investors, people betting against it. But it's not like widespread conviction that the company's going to collapse either.
Okay, so some doubt, but not overwhelming negativity there.
Right. What's kind of fascinating, though, is the technical picture right now. Intel is currently trading above both its 50-day moving average, around $21.98, and its 200-day moving average, near $21.69.
Oh, interesting. So technically looking a bit better recently.
Yeah, it's actually a positive technical signal. Suggests maybe a shift in momentum after it broke below those levels back in July, probably driven largely by that recent strategic investment news, the government stake.
Okay, let's dig into that ownership structure more. Chapter 5. Who owns Intel? I look at the stakeholders. Who actually owns a piece of this silicon giant, and how is that changing with these big investments coming in?
Well, like most big companies, 65–70% of Intel is institutionally owned. Mostly passive index funds. BlackRock, Vanguard, State Street are the top holders.
The usual suspects.
Exactly. Which provides stability, sure, but often means less active pressure on management from those big holders. Insider holdings, exceptionally low. Like 0.03%.
3%.
Yeah, tiny. And there have been more sales than buys recently, though, some sales are just for taxes. It is worth noting, former CEO Gelsinger was a consistent buyer of the stock, and the new CEO, Tan, made an initial purchase, kind of a symbolic gesture. But the really profound changes are these new concentrated owners. SoftBank Group put in $2 billion at 23 cents a share back in August, gives them just under 2%. Seems like a financial investment, no board seat mentioned.
Okay, SoftBank's in. And the government.
Right. Even more significantly, the U.S. government announced an impending $8.9 billion equity investment just recently, August 22nd. That could give Uncle Sam about a 10% stake, potentially making the government the single largest shareholder in Intel.
Wow. 10%. That's a huge shift, isn't it? It raises a really important question, though. The U.S. government's investing for national security, right? Not pure profit. Could relying so heavily on government aid actually, mask underlying problems or distort the market? Maybe even subordinate common shareholder interests to national interests. What do you think?
That's a very sharp observation. And it's a critical consideration for any investor looking at Intel now. You're right. The government's motivation is national security.
Huh.
Domestic supply chains, resilience. It effectively makes Intel a quasi-strategic national asset.
Quasi-strategic.
And while that provides this powerful backstop, that too important to fail dynamic we mentioned, it also means the company's decisions might not always be purely optimized for maximizing shareholder returns in the short term. National interest might take precedence sometimes. It's a delicate balance. And for investors.
Yeah, it definitely adds another layer of complexity to the whole story. Absolutely. Okay, now for the crucial Chapter 6. Risk assessment. What are the major risks that could derail Intel's very ambitious plans, beyond just the financial strain we've covered?
Yeah, if we connect this back to the bigger picture, maybe a quick SWOT analysis helps frame it. Strengths. You've got the brand, market leadership, even if diminished, that advanced manufacturing scale they're building, extensive IP, and that U.S.-based leadership.
All right, the positives.
Weaknesses. Loss of tech leadership historically, that poor execution track record we discussed, a high-cost structure, especially with fabs not running full, and a complex global supply chain.
Right, the execution challenge.
Exactly. Opportunities. Explosive growth in AI and data centers, that big potential in the foundry market entry, and of course government support via the GHPS Act. Huge opportunity there. And threats. Intense competition, TSMC, AMD, NVIDIA are relentless. Industry cyclicality is always a risk. And high customer concentration relying too much on a few big buyers.
Okay, that covers the internal stuff. But what about external forces? Macroeconomic, geopolitical, how do those threaten Intel?
Especially a company trying to build out domestic manufacturing now.
Oh, hugely. Inflation is a direct threat. It pushes up costs for everything they need to build these new fabs, materials, labor, equipment, strains that already massive CapEx budget.
Makes billions go less far.
Precisely. Rising interest rates increases borrowing costs for all this debt-fueled expansion. Plus, higher discount rates just generally reduce the intrinsic value calculation for any company. Geopolitically, it's a real double-edged sword. The U.S. government's aggressive trade stance, provisional 20% tariffs on semiconductor imports announced in August, threats of 300%.
It sounds like it could help Intel.
You'd think so, right? Intended to benefit domestic producers. But it could also disrupt Intel's own global supply chain. And critically, it risks retaliatory tariffs from China. China was 27% of Intel's revenue in 2023.
27%, that's huge exposure. Massive. So Intel is caught in the middle, a beneficiary of U.S. policy in some ways, but also a potential victim of the escalating U.S.-China tech rivalry. Trying to build fabs here while still needing to sell chips everywhere, it's tricky.
Okay, we've covered a lot of ground. We've arrived at Chapter 7. Conclusion. Let's try and bring it all together. What's the synthesis here? The ultimate bull case and the ultimate bear case for Intel?
All right, the bull case. It really boils down to 3 core points, I think. First, strategic imperative and government backstop. That national champion status, GCHP's Act support, direct government equity. The feeling is maybe it's too important to fail.
The safety net argument.
Kind of.
Yeah.
Second, enormous market opportunity. Intel is pivoting to these huge growth areas. AI, data center, automotive, they capture even a decent slice. It's massive. Third, deep value potential and new leadership. The stock is priced for current distress. There's significant upside if the turnaround works. And maybe Lip Bhutan is the guy to execute it.
Okay, that's the optimistic view. What about the bears?
The bear case is equally forceful, maybe even more straightforward. First, severe execution risk. IDM 2.0 is incredibly complex, incredibly expensive, and Intel's track record on big projects lately, not great. Delays, missteps.
History weighs heavily.
It does. Second, intense and relentless competition. They're fighting TSMC, AMD, NVIDIA, all on different fronts. And those competitors are arguably at the peak of their powers right now. It's brutal. Third, protracted financial drain. We talked about the cash burn, billions disappearing for potentially several more years. That leaves the company very vulnerable, especially if there's an industry downturn.
So bringing it back to valuation, what does this all mean for Intel's stock price, given these two dramatically different potential futures?
Well, let's reiterate that DCF intrinsic value range we calculated, $22 to $30 per share. And the current share price, $24.80, falls squarely within that range.
Right in the middle.
Exactly. Which implies it's potentially fairly valued today, only if this high-risk, high-stakes turnaround actually succeeds. There's really not much of a margin of safety priced in right now. Fundamentally, buying Intel today is a speculative bet on future execution, pure and simple. And the outcome, like we said at the start, feels pretty binary. Either a spectacular recovery or, well, a prolonged and painful failure. Which leaves us with a final thought, maybe. If Intel's future really hinges on this unique status as a national champion, and its ability to rebuild trust through truly flawless execution, how much weight should an investor realistically place on that geopolitical support versus the cold, hard financial results we're seeing right now? That's the really tough question to ponder.
That's our deep dive into Intel Corporation. A complex story for sure. Remember, you can like and subscribe to the Stock Analytics AI YouTube channel. Members paying $4.99 a month get priority deep dives on tickers. We're actually covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access. And if you just want a one-off deep dive on a company you're interested in, drop us a super thanks. We'll bump it up the list. Just one final important note. This analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.